Let's talk about something you probably wondered about. Do you really want the lowest mortgage rate possible? It sounds like a no-brainer, right? Who wouldn't want the cheapest deal? But hold on, there's more to this than meets the eye. And chasing that elusive lowest rate might not be the win you think it is. Let's get real about the mortgage market. Rates aren't static. They're moving all the time, up and down, throughout the day, every single day. Think of it like a stock ticker, constantly shifting based on economic news, lender decisions, and global events. And here's the first big reality check. At any given moment, only one lender can technically have the quote-unquote lowest rate. It's just a snapshot in time. But within minutes, the market shifts, that lender's pricing changes, along with every other lender across the country, and now someone else could have the new lowest rate. And it happens all day, every day. It's not that lenders are playing tricks, it's just the nature of a market that's always in motion. Now let's talk about what it really means to chase that low rate. First off, not everyone qualifies for the same deal. Your credit score, debt-to-income ratio, loan size, and even the type of home you're buying all play a role. Good mortgage bankers won't just hand you a single rate. They give you a range of options. And here's where things get interesting. There's a trade-off between rates and costs, and it's a big one. Rates and costs are like a seesaw. On one side, you've got the interest rate. On the other, you've got fees. The higher the rate, the lower the fees, and the lower the interest rate, the higher the fees. When you start getting into the lowest interest rates, you're typically paying points, which increases the cost of the loan. What are points, you ask? They're fees you pay to buy down your rate. 1 point equals 1% of your loan amount. So on a $400,000 mortgage, 1 point costs $4,000. Want that ultra-low rate you saw advertised? You might need to pay 2, 3, or even more points at closing. That's $8,000, $12,000, or more just to shave a fraction off your rate. Sounds steep, right? But here's the flip side. If you're okay with a slightly higher rate, your upfront fees can drop. You can even get a rate where instead of you paying fees, the lender actually gives you a credit, which could reduce the cost of the loan, or even eliminate all costs paid by you. So why is chasing the lowest rate a risky move? Let's do the math. Let's say you pay $10,000 in points to get a rate that saves you $100 a month. It'll take you over 8 years to break even on that upfront cost. But here's the thing. Most homeowners don't keep their mortgage that long. People typically refinance every 2 to 5 years on average. If you refinance or sell before you've recouped those costs, you're out thousands of dollars with nothing to show for it. Not exactly a win. The truth is, the lowest rate isn't always the best deal for you. What you really want is pricing that fits your financial situation. Maybe you're planning to stay in your home for a decade. Then paying points for a lower rate might make sense. But if you're likely to move or refinance soon, a slightly higher rate with lower fees could save you thousands of dollars up front. Here's the bottom line. Chasing the lowest mortgage rate is a losing strategy for most people. It's a moving target. And even if you hit it, you might end up paying more upfront than you'll ever save. Instead, focus on what saves you money in the way that matters most, whether that's lower payments, smaller closing costs, or a plan that fits your timeline. You're not a rate-chasing robot. You're a homeowner with real-world needs. So skip the wild goose chase. Work with a lender who understands you and your financial situation and lock in a mortgage that feels like a win, not a gamble. For more information or to get a free quote, visit MikeTheMortgageGuy.com.